Venture capital isn't the only way startups get funded and supported. In the early stages, founders often turn to accelerators, incubators, and venture studios, each offering a different approach to helping startups grow. While they all provide guidance, resources, and sometimes capital, their structures and goals are quite different. Let's explore what each of these players does, how they work, and when a startup might choose one over the others. Imagine you have a startup idea, but it's still in its earliest form. You don't have a product, a team, or even a clear business model, just a concept with potential. This is where incubators come in. Incubators help founders in the earliest stages of their journey by providing a structured environment where they can refine their ideas, build prototypes, and develop their business models. They often offer office space, mentorship, networking opportunities, and access to industry experts. Unlike venture capital firms, incubators don't usually take equity in exchange for their support. Some operate on a nonprofit model, often funded by universities, governments, or corporations looking to foster innovation. Others charge startups a small fee to participate in their programs. The key value of an incubator is time and resources to develop an idea before taking on external investment. If you're an early-stage founder with an unproven concept, an incubator might be the best place to start. While incubators nurture raw ideas, accelerators help existing startups grow fast. Accelerators are designed for startups that already have a prototype, some initial traction, or early revenue, but need capital, mentorship, and investor connections to scale. These programs typically run on a fixed time frame, usually 3 to 6 months, where startups go through an intensive process of mentorship, networking, and business development. The goal? To get them ready for their next funding round. Most accelerators provide some capital in exchange for equity, usually 5 to 10%, and end with a demo day where startups pitch to investors. Founders and accelerators get access to high-profile mentors, venture capital firms, and strategic partnerships, all within a fast-paced, high-pressure environment. Many of the world's biggest startups, like Airbnb, Stripe, Dropbox, and Reddit, came through accelerators. Accelerators are best for startups that have a working product and want to scale quickly. The program is intense, but the networking and funding opportunities can be game-changing. While incubators and accelerators support founder-led startups, venture studios take a different approach. They build startups in-house. Instead of waiting for entrepreneurs to pitch ideas, venture studios identify market opportunities, develop business concepts, and recruit teams to run them. Venture studios act as co-founders, often coming up with multiple startup ideas and testing them before committing full resources. They provide funding, expert teams, and infrastructure to launch new companies efficiently. The big difference between venture studios and VCs is that venture capitalists invest in existing startups, while venture studios create companies from the ground up. Because they are so deeply involved, venture studios retain significant equity in the startups they build, often 30 to 50% or more. This model reduces the risk of failure because startups benefit from experienced leadership, a pre-validated idea, and built-in funding. However, it also means founders recruited to run these startups have less ownership than they would in a traditional startup. Venture studios are ideal for experienced operators who want to lead a startup but don't necessarily have their own idea. They offer a structured, lower-risk path to entrepreneurship compared to launching a company alone. Deciding whether to engage with an incubator, accelerator, or venture studio largely depends on where a startup is in its journey and what kind of support it needs. For entrepreneurs who are still in the idea stage and are seeking initial guidance, an incubator often provides the ideal environment. Incubators help founders shape their concepts, refine business models, and take those crucial first steps toward building a viable company. On the other hand, if a startup has already achieved some early traction, such as developing a product, acquiring initial customers, or validating its market, an accelerator can be the right next move. Accelerators are designed to help startups grow rapidly by offering funding, intensive mentorship, and access to valuable networks. Meanwhile, for individuals who are eager to lead a startup but do not yet have a business idea of their own, a venture studio presents a compelling option. Venture studios create and validate ideas internally, and then pair them with entrepreneurial leaders, providing built-in support, resources, and infrastructure to help launch new companies from the ground up. All three of these players, incubators, accelerators, and venture studios, fill crucial gaps in the startup ecosystem. While venture capital fuels high-growth companies, these programs help create, develop, and prepare startups for that next big step. For founders, understanding these different models can make all the difference in choosing the right path to success.